So inflation is a very difficult thing to call at the moment. We've clearly seen this amazing spike in inflation as authorities effectively flooded the system with liquidity in COVID. And it left us with too few goods and too much money. And the result was inflation. Now, for years and years, inflation's come down fairly effectively every time central banks have raised interest rates. But this time it is proving a little more sticky or a little more persistent. Some of the reason for that is because it went so high and therefore becomes somewhat embedded in the economy. And some of the reason for that is because it's service inflation as opposed to goods inflation, which also tends to come down more slowly. Balanced against that, we have had interest rates go up an awful lot, and they influence the economy with a long and variable lag. If we therefore move into a slowdown, you may see inflation dissipate. Now, the core point is this. We don't really know what's going to happen to inflation. There are structural reasons why it could be higher. There are cyclical reasons why it could be lower. We're not managing the portfolio based upon an inflation forecast. And we think we're reasonably well placed either way. If inflation comes down very quickly, then the sorts of businesses that we own will benefit from receding input costs to the benefit of their margins. And if inflation tends to be a little bit more persistent, what you need is businesses that have pricing power. And that comes from having a quality business with such things as brands, attractive margin structures, and so on, so they can cope with a more inflationary world. So either way, I think the trust is relatively well positioned, but we think it's very hard to say exactly what inflation will do from here.
It seems that inflation is a bit stickier than people hoped, and we see fundamentally two scenarios. The first one is one where economic growth continues to be robust. Inflation remains above the 2% target that many central banks have, and that will have implications for interest rates, i.e. interest rates will not come down as fast as markets have anticipated. On the other hand, the continued high interest rates environment in which we find ourselves in might eventually lead to a consumer slowdown and a recession. And what that could in turn imply is that inflation will eventually come down because of a tough economic environment. I think either way the outlook is very uncertain, but what I would like to stress is that our portfolio is not managed based on an inflation forecast. And our companies should be able to perform well both in inflationary times and not. When inflation is high, our businesses have good brands, high margins, and the ability to pass on price increases to consumers. If inflation comes down because of a tough economic environment, well, our allocation, for example, to the consumer staples sector and the healthcare sector means that most of our companies will be protected from a tough macro environment, which will in turn lead to better performance relative to the broader equity market.